Good afternoon, everyone. Welcome to the Innovate Finance half-year webinar on investment in fintech. This follows up from the report we published last week, which sets out what's been happening in investment in the UK and globally in fintech in the last 6 months. We have assembled an expert panel this afternoon to talk about those numbers, to give some real understanding behind what is going on in the market, particularly how difficult the market is at the moment. So before we kick off, I'm going to ask everyone to introduce themselves on the panel. First of all, my co-presenter, Veronica.
Hi, I'm Veronica Glab. I'm head of partnerships and the investment program at Innovate Finance. So Mike and I have produced the investment report together, tracking global venture activity into seed through Series I fintech companies. We'll go into that later. But when I'm not working on the investment report, I develop our investment program to connect startups at different stages with VCs and strategic partners, and build a peer-to-peer network of some of the investment banks who are partnering across the fintech ecosystem.
Thanks, Veronica. Next up, Steve Levin from Volution, who's going to be really getting into the detail of the discussion on VC investment. Steve.
Hi. Steve. I still identify as a recovering founder, actually. I was co-founder of Currency Cloud, which we sold to Visa at the end of, well, we agreed the deal at the middle of 21, but the transaction closed at the end. So we got out right at the peak, which was very fortunate. But now I'm partner of Volution, leveraging my experience and network and 13 years of founder experience in the trenches.
Thank you, Steve. We have Simi Shah from City of London. Simi, if you'd like to introduce yourself.
Hi, I'm Simi from the City of London Corporation. We work to strengthen and promote FPS, both at home and abroad. I'm the Trade and Investment Director and pretty much do what it says on the tin. My team works to raise investment levels for businesses in the UK in the FPS ecosystem. And we create platforms, again, here and abroad to showcase the amazing things going on in the UK.
Thank you, Simi. Next up, I'm going to ask James Deal from Primary Bid to introduce himself. This time in the report, for the first time, we are covering IPOs and listed. So James, if you can just tell us about yourself and Primary Bid.
Thank you. So James Deal, founder and head of UK at Primary Bid. Primary Bid is a technology-driven platform that helps put individual investors, that's really the public, on an equal footing with larger institutions when companies raise capital. So we work every day with existing listed companies and of course with businesses when they seek to go public at their IPO, and give that equal access on the same terms and same timelines as the institutional offer.
Thanks, James. And our final panelist is Adam Jackson, Chief Strategy Officer here at Innovate Finance. Adam has just published the FinTech plan for government. And Adam, just give a little background to yourself and that plan.
Sure. As Chief Strategy Officer at Innovate Finance, I lead all of our engagement and policy work with government and regulators, where we advocate for policies and approaches that continue to support a vibrant fintech ecosystem.
Great, thanks, Adam. So just before we get going, a quick reminder, if anybody has questions, then put them into the live chat. You'll see there's I'm sure you're familiar on Bright Talk with chat function. We've split the discussion up into a number of different topics, and at the end of each topic, we'll take any questions that are there. So feel free to ask questions as we go through, and we'll try and take as many as we can. So what are we going to cover today? We're going to talk about the highlights from what happened in tech investment in the first half of 24, and what's the outlook, what do we think is coming down the pipe. We're also going to talk about the IPO market and listed markets, because that's becoming increasingly relevant to fintech. And we're going to be talking about the plan for government and how that can potentially help to stimulate investment, and is very precedent given we've just had the election. And what we're really, just pop back a second, what we're really trying to also understand is, have we reached the bottom of the investment cycle? And some of you may have attended our event at the beginning of January, where investment had fallen in the second half of last year. We had a panel there. Simi actually was on that panel. The panel actually were fairly negative in outlook then, saying they didn't reach the bottom and they weren't expecting it to start picking it up this year. So we're going to carry on looking at that and trying to say, well, have we reached the bottom yet? So to kick us off, we're going to give the highlights from the report that we published. You can find the report on our website, but if you have to hand or if you haven't read it, here are the highlights, because this really frames the context for a lot of the discussion. I'll pass over to Veronica for this.
Great, thank you, Mike. So happy to go over some of the key headlines that have come out of this report. So this is our half-year update, which has covered 1st of January 2024 all the way through the 1st of July of this year as well. Every year in January, we also publish a report looking at the past year in retrospect and making a few, light touch predictions or diagnoses on what the next year could shake out like. So again, this half-year report is really checking in on where we left off in January. So I'm going to go over through some of the stats, but as Mike said, this is very much an interactive session. So please feel free to come in with any questions, particularly as the basis of the report is tracking over 20,000 seed through Series I venture deals across the globe. So the really cool part is we can tell you how many payments deals took place in the US in 2013 versus how many crypto deals took place in Tokyo in 2017. The data gets very granular. It tells a really interesting story. So again, feel free to ask any questions as we get in, but the headlines. So global fintech investment is currently still trending downwards, down 19% in this half of the year over the coming off of the period from July to December of 2023. So down 19% since then. Mike, I believe, no, we don't have a typo there. UK fintech has fared a little bit worse looking at the same period and down by 37%. Those percentages are in terms of the dollar amount that is invested, not in terms of the deal flow. Nevertheless, the UK has very much demonstrated its resilience as a market. It remains number 2 globally, behind only the US, as it has done for, I believe, the past 7 years. Not only does the UK continue to be the number 1 in Europe, as it has for the past 5+ years, but it continues, and Mike, you can correct me if I'm wrong, to have attracted more capital than the rest of the European Economic Area combined. So it does still give you an indication of the UK market size and a proportion of the global total. And then Mike will cover a little bit more the UK IPO market, which is actually up overall in this first half of the year over the second half of last year. So those are our key headlines, but looking at the global fintech landscape once again, the US attracted almost $8 billion into its fintech sector across just under 600, a nice even 600 deals globally. So that's still significantly down from last year in terms of deal flow. That also explains how the US has gone from about 15 million in 2023 overall to just over 7 billion so far this year. The US may or may not be on track to meet its total 2023 investment influx. It's still a little bit early to tell, simply because deal flow has been significantly down. But again, if we look at the UK in proportion, so we're looking at $2.01 billion into the UK fintech ecosystem across 184 deals. And then once you go into countries 3 to 10 in terms of the top 10 global markets, India is significantly further down, followed by China, Germany, Brazil, Singapore, Netherlands, Australia, and Hong Kong. Notably, India, Singapore, Hong Kong, and Australia pretty frequently make it into the global top 10. China, 1 year it's in, 1 year it's out, has a very yo-yo effect of a fintech market. And just curiously, Singapore is quite significantly down, with only 99 deals at about $300 million into its fintech sector so far this year, and that's down from just under 3 billion last year. So Singapore actually had a boom year in 2022 and 2023, and it's now feeling a somewhat delayed slowdown in investment. Last year in 2023, we also reported that the UAE had, from 2022 to 2023, investment levels had jumped from $600 million in the UAE in 2022 to $1.2 billion into its fintech sector last year. That put the UAE on the global top 10 map for the first time last year, and this year the UAE is significantly down. We're going to zoom in a little bit closer to home to look at the European continent. And again, the UK as a proportion of the European total. The UK has attracted more capital than the rest of the European Union combined, with 184 deals. We see a really steep drop down from the UK to Germany, which brought in just under $500 million across only 37 deals. The Netherlands, Sweden, going down all the way to Estonia at number 10. So Romania and Estonia have done 3 and 5 deals respectively, which just does go to show how much deal flow is quite further down. When looking at Europe overall, 2 countries are on track at the moment or have exceeded the amount of investment they've pulled in across the entirety of 2023, and that is the Netherlands and Sweden. So they've actually already pulled in more capital across fewer deals, thanks to a few later stage deals. Germany is possibly on track to meet its previous year of investment. But just does give you a picture that not only is deal flow down, but deal flow in the UK and Europe is also very much largely concentrated towards early stage deals. So seed and Series A taking the vast majority of those deals. In the UK, 165 deals of the 184 were at the seed or Series A stage. What that means in terms of the UK regulatory landscape, my colleagues Mike and Adam will go into that a little bit further. So I won't take too much attention away from that, and I'm going to hand it back over to Mike to look more deeply.
Thanks, Veronica. And we had a question on the chat about what's the source of our data. So most of our data comes from PitchBook. Sometimes on the UK we supplement it with some data runs from Bovas. Mostly this comes from PitchBook because they provide global data and we want the data prepared in a consistent way. Just to finish off this section on the data, there's a couple of charts that aren't in the report but just kind of help to frame the discussion. So this first chart shows global VC investment versus global fintech investment since just before COVID on a half-year basis. We've rebased the numbers starting in the second half of 2019 and shown the trend in investment through COVID and coming out the other side. And so this shows for each half year how much investment was there compared to the base year of the first half of shown on here, H2 2019. So you can see the blue bar shows the global VC investment excluding fintech rose pretty dramatically up to that peak in N21-22 and then fell. And in the last 3 halves, it's sort of, maybe it's stabilizing, don't know, it's sort of starting to flatten out. Fintech investment really grabbed the ball by the horns, accelerated faster than investments in other sectors, and again had that peak N21 beginning of 22, and then fell along with other fintech, other VC investment, but actually fell faster. And you can see that by the first half of this year, fintech investment had fallen further on a relative basis than investment in other sectors. So one thing, it shows that fintech investment moves in the same kind of cycle as other VC investment. Maybe it has a beta greater than 1, but it's moving in a similar cycle. But it's difficult to see from these numbers that fintech investment has finished falling. Other sectors look like they may have flattened out, but on this, it looks like fintech may still be falling. For the UK, these numbers are 12-month rolling numbers to see what happened in the UK, and you see it's the same pattern going back, starting in the 12 months to H2 2019, and you can see the big run up end of 21, beginning of 22, and then the fall again. And you can see it follows the same pattern that we saw for the global investment trends. And if you look at the last three halves, and again these are rolling 12-month numbers, it looks on these numbers that it's continuing to fall. It's been falling for a number of half years, and that's sort of where we are at the moment, and that's what we want to really get into discussion with now. So that's a summary of the report. There's a lot more in the report if you want to see it, but those are really the key items. We want to kick off with the investment market and to get Steve's views around what has been going on in the market. So why did the market have that big run up? Why is it fallen away again? Are companies not wanting to issue? Is it that VCs aren't investing? Steve, what are your first thoughts?
$1 million question. I think in simple terms, a lot of this is down to typical market dynamics and the inevitable correction. The market was growing very fast for quite a period of time, as we've just seen, and private markets are cyclical in the same way that public markets are. And it got to the point, I think, we were seeing some phenomenal multiples leading to some phenomenal valuations in many corners that just become unrealistic and probably unsustainable. So a little steam coming out of the market is probably a good thing. I think at the peak of the market in 21, there's also a significant element of foreign capital coming into play. A lot of overseas investors, perhaps with not as much experience investing in the UK as the domestic investors. And this is typically directed at later stage companies and generally much larger deals. Sort of 100 million pound deal sizes. And obviously after this correction, we're seeing a retrenchment of this foreign capital. The traditional growth investors that are remaining and have a long-term presence in the UK market are now at a stage where they're looking for more proof points and more positive KPIs before they commit. And what you're seeing here is a trend that ultimately leads to longer investment cycles, which then means that more of the ventures themselves, the startup companies, are looking for bridging rounds or extension rounds to achieve an optimal outcome rather than going too early with the bigger round. They're reluctant to raise a big later stage round whilst valuations are suppressed. And then in parallel to this, founders have reacted to these new norms. They are new norms, I think, for the time being, by cutting their costs and shifting their operating models to this new paradigm of profitability rather than just investing in growth and burning capital. And the amount of conversations I've had recently where people are saying, oh, well, we're just going to pursue break even for the time being rather than growth. And those that have managed to do so ultimately require less capital, become less capital intensive in the short term as they reposition their business for the growth in the longer term, which ultimately leads to a better run business in my experience. All of this is immediately painful, but ultimately I think probably a good thing.
So you're saying that the VCs are taking a little bit longer to make their decisions, and the companies need to prove themselves more and hold on for longer and get towards profitability.
I think there are three things at play here. One, there is a bit of conservatism in VCs. You're absolutely right. Yes, I do think that some of the more savvy founders, certainly the more confident founders, are being a bit more patient with when they go for growth. But also, let's not forget the VC market itself. I mean, we require investors to operate as well, and the funding market for venture funds has been very difficult, very challenging. And I think what we're seeing is a couple of there's talk of last year being very good vintages. We're still seeing good opportunities, good deal flow, but but certainly it's just the whole market across the board, from a supply side, demand side. It's just a lot more suppressed.
I've seen some comments that VC fundraising, to your point, is down 50% this year. So are you expecting VC funds to have less available to invest in the next few years?
Yes. Yeah, it's been a very challenging market for VCs as well. The same funds that were burned by the high valuations that we saw at the peak will be the ones that are feeling the most pain right now, because there's been a lot of talk about entire funds being written down or written off in some of the horror stories we saw. But it's just going to be increasingly challenging for these fund managers to raise subsequent funds until they demonstrate a return to their existing LPs.
No, it's not all bad news. So there are some deals getting done. So the second largest deal in the UK in the last half year was by Flagstone, which raised $170 million, which is one of your portfolio companies, I believe, Steve.
It is.
Do you want to just tell us a little bit about Flagstone and what they were raising for?
So I'm a big fan of Flagstone. I was a big fan of Flagstone before this most recent deal. I think it's a great business, but they're a perfect example of the kind of organisation that we invest in at Volution. They are increasing efficiency and productivity in the capital markets. Effectively, their platform makes it much easier for savers, not necessarily investors, but savers who want to open multiple bank accounts to achieve the optimum blend of best interest rates based on the term that they want to invest for, but also sailing beneath that financial services compensation scheme limit. And the platform allows one sign up and one sign in to access something like 200 accounts across 60 providers, 60 different banks. And our investment thesis when we went in was that as interest rates started to rise, savers would be drawn to tech-enabled platforms to meet these savings needs. And obviously, Flagstone is now one of the largest cash savings platforms out there. In fact, if not the UK, in fact, it is the UK's largest cash platform. And they've got something like 11 billion AUA now since launch in 2015.
And they were able to raise 170 million because they've got a good story. They've passed profitability. What were their key features?
So all of the above, all the metrics were up and to the right. It was the perfect growth story actually over the last 2 years. As interest rates rose, just all the metrics were tracking up. New investor sign-ups, new banks coming to the platform, AUA was growing, revenue was growing, and Estancia Capital invested, I've got £108 million, which in my head doesn't quite reconcile with $170 million, but it's some sort of number. Was a significant majority of that was actually a secondary investment, giving liquidity to existing investors. There was a big chunk of that was primary as well, but the majority was secondary. Now, for me, a private equity firm like Estancia coming in and participating in such a large secondary round at this stage in this market is a massive vote of confidence. So we're very confident about the business going forward.
Okay, that's great.
If I can just pipe up for a second as well, I've got two questions from the audience, and I think while we're still covering the VC space, might be worth addressing. So Liliana Rizor from Superfin has asked if the FinTech investment figures include investments into crypto-related projects and companies. Very quickly, yes, largely they do. So the way that PitchBook categorizes, it does occasionally categorize crypto and blockchain as a separate category. We have included crypto and blockchain here, wherever it's categorized as FinTech. But since some blockchain technologies can obviously be applied to non-financial services industries, there may be some deals that don't get fully categorized into this. Anything related to crypto, digital assets, and the relevant trading platforms is in the report. And then just looking quickly at the global review, so Shmuel Ben Tovim from the Israel FinTech sector has asked, where is Israel on that global list? So very quickly as well, Israeli companies in 2023 raised over 274 million dollars across 37 deals, and that dropped to 154 million so far this year across 12 deals. It is, however, important to note that whenever a given country is looking at its own fintech ecosystem, that you look at the deal site as well. There have been a number of Israeli companies who have done transactions in the UK, the US. So it's, that's one case study where we're looking at where the deal site is different, where the company's headquarters are. So that's where we also see in the global landscape, for instance, as UK companies start to do growth stage post-Series C deals in the US, for instance, those deals in databases like PitchBook or Dealroom are tagged by deal site. So again, the investment report that we look at, it does cover global venture activity, but it's not always the holistic picture of what a particular country's ecosystem looks like, because we're obviously seeing some massive success stories of growth as well, which again we'll continue to go into on the conversation today. We've also got another question about maybe the slides after the event, and Mike, I think you're the authority on the slides today, so you're going to have to take that one.
We'll distribute those. That's fine. Great, thanks, Veronica. So I'd like to bring Simi into the conversation now, because as we've heard from Steve that the big splurge in fintech investment a few years ago, a lot of that was caused by foreign capital who probably aren't going to come back. We've also heard that VC fundraising is down, and that's probably going to hit deployment in the coming years. So that suggests that capital available for investment is not going to be as strong in the coming years as it was in the recent years. A year ago, Simi, you're closely involved in the launch of the Mansion House Compact that was announced, probably was in July last year, actually, at the Mansion House dinner, which is looking to try and help combat and rectify that. So I'd like to just talk about where that's got to. Perhaps to start off with, Simi, you can just recap in a few sentences what the Mansion House Compact is about and what it's trying to achieve.
Of course. Thank you. So last year, as you said, I've got a bit of feedback. Maybe that's okay. Okay. Last year, the corporation, as you said, led a voluntary industry-led initiative to unlock capital via private asset investments into high-growth sectors such as fintech. And we did this for 3 reasons. As Steve and you have both alluded to, the UK is good at helping companies off the ground, but lacks some of the deeper pools of accelerator-type capital. And this has, you could see it as an opportunity or as a challenge. It's an opportunity for the individual companies, but on the UK level, sort of forcing a cohort of companies to head to non-UK capital providers to secure scale-up funding. And we want to ensure that high growth firms have choice, so they can take an international investment and they also have domestic pools available to them. And that in time, we keep more fintech and biotech companies, for instance, here that want to stay here. Additionally, the long-term capital in the UK has been slowly divesting from high growth private placements. And this is a bit of a mismatch, right? Because long-term capital should be matched to long-term opportunity and companies that are growing. And so this kind of, felt like a mismatch to us, and frankly still does. And then finally, a year ago, and I think this is still shared, is that there was widespread concerns about the financial position of UK savers at retirement. It's been going down. I didn't actually bring the figures with me today, but happy to share them wider. It's quite shocking. And the other issue is that innovative UK companies are taking, a disproportionate amount of international capital, which in some cases, of course, is exactly what we want. But the savers from other jurisdictions are benefiting from those rewards rather than UK beneficiaries. And again, we want UK beneficiaries to have choice. So there's kind of an interesting link between the 2 ends of that chain. So a year ago, almost to the day, the then Lord Mayor, Nick Lyons, announced the signing of the Mansion House Compact, which was a commitment by some of Britain's largest pension firms to allocate a minimum of 5% of defined contribution, so DC funds, to unlisted equities by 2030. And the ultimate aim, we did have some math in this in our Powerful Pensions report, of unlocking over 50 billion in new capital by the end of this decade. There were 9 signatories on the day: Aegon, Aviva, L&G, M&G, Mercer, Nest, Phoenix, Scottish Widows, and Smart Pensions, and then 2 additional signatories joined in the autumn, Aon and Cushion. As I said, in the autumn, October 2023, on the morning of our Mansion House Summit to convene the value chain around this, the BVCA also announced the VC Compact, which was, again, a voluntary compact between VCs to support the aims of the original compact. So that's the recap in terms of where we've got to now. Since an idea that came out of the October Summit is for the Association of British Insurers, the ABI, to lead the value chain on a report which both looked at the baseline a little bit closer. The Powerful Pensions report in March 2023 did that, but ABI has done some wonderful work in digging out a little bit further about where we're at. And this will be published in full later this summer, but I can make some general points on it and in progress generally. So the current baseline is that only 793 million are held in unlisted equity assets. So that's 0.36% of total value of DC default funds. So there's a lot of work to do on that 5% target for sure. But the divestment has happened over a generation, and it will take some time to course correct. So that said, a year after signing, we're definitely seeing a lot of movement, and the progress is measurable. So 5 out of our 11 signatories have reported an increase in allocation, and 10 of the 11 of them have taken concrete steps to improve their expertise in unlisted assets, which was one of the call-outs in the Powerful Pensions report last March. And 8 of them have put together specific investment products, such as long-term asset funds, or LTAFs, and I'll just mention just a handful. So on the 1st of July, L&G announced the launch of the Private Markets Access Fund, which offers its 5.2 million DC members an opportunity to diversify into unlisted asset exposure. Again, remember, this is about choice, not necessarily forcing savers to do certain things. And L&G will utilize its 48 billion private markets platform to source investment opportunities. And L&G has the mandate to allocate up to 40% into UK assets. On the 19th of June, Aegon announced the inclusion of private markets and enhanced ESG integration into its largest 12 billion workplace default fund. And in November 2023, the British Business Bank announced its plan to launch a growth fund as an LTAF to offer access to VC investments to the DC pension schemes. The idea was to draw on the BBB's permanent capital base of over 7 billion, with the bank consulting with the industry on how best to structure it. In order to do this, they would need to become a fully regulated entity, but this plan to do so is progressing. And lastly, a non-signatory, Willis Towers Watson, announced its proposal to launch a private equity-focused long-term asset fund, which aims to boost long-term returns via productive finance. The fund has commitments of over 450 million in assets, including a commitment from LifeSite to invest up to 5%, as per the compact. So we take this as an interesting sign that sort of a new industry standard has been established, which even now non-signatories are responding to, which is great. It sort of underlines the voluntary aspect of this. People are doing this to respond to their stakeholders, to the market, and to what they believe is a commercial opportunity. I might stop there, Mike, because I know you're going to have some excellent follow-up questions for me.
No, thanks, Simi. That was really helpful. I've seen some commentary in the media from people grumbling, saying, "Oh, this is taking too long. It's too difficult. Is it really going to happen?" I think that's partly because there aren't many announcements that have come out. But I think what you're saying is there's a lot that's been going on behind the scenes, and we're now starting to see announcements come out. People need to be patient, and it looks like the vehicles and the intent should produce the flow, but it'll take a few years. Is that right?
Yeah, and I get it's frustrating, right? You know, we want this money to be going. I want it to be going a year ago as well. But again, as I mentioned, this kind of odd mismatch between capital has been happening over time, and it's going to take time to correct it. And I think, you know, let's be honest, there's a lot of work to do here. One of the other criticisms is that the LTAFs are kind of costly. And if you are just looking at it quickly on paper, cheaper schemes are available. And this kind of comes down to benefit consultants and trustees and savers, understanding what's happening here and taking informed choices around where they put their money for their ultimate savings profile. My have been spot on. This is a culture shift, and it's a massive education piece, and we all just need to kind of keep together on it. Sorry to interrupt you, Mike.
No, thank you. So the National House Compact should be beneficial, but it's not going to cause investment to spike in the next 6 to 12 months. It's going to produce capital. And I think just to come back to Steve, just to kind of wrap up on what's been happening in the market, we've been a bit backward looking, but when you look forward, you look at your pipeline at Volution, Stephen, when you think about what's coming, I mean, what would you expect UK investment into fintech to look like in the next 6 to 12 months? What does your crystal ball tell you? You've just got to say up, down, or flat.
Another $1 million question. I mentioned earlier I'm a recovering founder, so I'm naturally optimistic. But the investment community is probably a lot more conservative than that. I think I'd like to think you start seeing an uptick by the end of the year. Certainly, we've got some interesting conversations going on the LP side, and I know a lot of people have. There you go. That's a non-committal answer for you. Okay.
But we discounted by 3 months because you're a natural optimist. Okay. Got it. Great. All right. Thank you very much, Steve. So now we're going to move on to listed markets in the UK IPO market. As I said, in the past, we have not focused on this market in our investment report, but we've realised it is something we should be focusing on. We have a lot of members reaching the stage where IPO is a very real prospect and an important part of their strategy as they move to the next phase of their business. We put some stats in the report about in the first half of the year, IPOs in the UK were up on the second half of last year, albeit it's fairly thin volume. So it would be dangerous to draw too much from that. So we're delighted to have James here today from Primary Bid, who is very plugged into the markets. James, can you tell us, I think more forward-looking than backward-looking, because the data is fairly thin looking backwards, how are you feeling about the IPO markets generally when you look forward for over the next 6 months?
Well, just to make the point, am I sound okay?
Yep.
So it's interesting. I think you've got to go back more than 30 years to see equivalent inactivity in capital markets generally. So that's existing listed companies raising money, but obviously IPOs too. It's a function perhaps of the fact that, with interest rates moving so swiftly, it's been hard for businesses to understand where their true cost of capital is, and therefore to make decisions, whether it's for an initial listing or to go cap in hand and raise more equity. As Primary Bid, we've been on every single FTSE transaction, that's FTSE 100 and FTSE 250 for the last 3 years. Increasingly, we get brought in by the lawyers, so the advisors to the company. I mention that because we keep very close to all legal counsel, and it's really, really interesting that the lawyers are being brought in today for potential transactions, IPOs, that go into the second half of this year and obviously into 2025. And I can't remember seeing such a busy and healthy pipeline of really great businesses, truly exciting homegrown British businesses seeking to list. Now, there's a big reason for London being venue of choice, and it's really to do with the fact that we've moved really fast to change the listing rules here in the UK, and we'll perhaps come on and talk about that in a moment. I think the fact that those changes came through only last week, came through ahead of time. We were expecting them to come through at some point during or post-summer. And I think it's a good sign that the regulator, the FCA, is moving as fast as humanly possible to make the changes required for the UK to stay front and center and be relevant on an international stage in terms of alternative markets.
In your knowledge and expertise of the markets, where do you feel the UK is positioned vis-a-vis the listing rules now? When these changes come in now, how does that position the UK compared to other markets? Are we in as good a place as other markets? If companies are looking to issue, should they no longer be worrying about whether there are differences in rules, or are there still things that are problems?
So I think that the simple answer to that question is that with 20 plus changes to the way that we set regulation around companies coming to market, we are now in a really, really good place, very competitive. We basically removed all the disincentives and the frictions that have been perceived to be around a UK listing. So if one thinks about all the press comment of the last year or two, it's all history. And that's, again, is why you're now seeing a fantastic growing list of businesses have already made the decision to list in London, because there's no benefit to going to New York or Amsterdam or Paris or any other venue. And what we've now got to prove, and come on to talk about this next perhaps, is that London can deliver very deep global capital and then a really broad register. And I think has every chance of becoming the most forward-thinking market out there, especially if you're talking about a UK homegrown business.
The first half of this year saw the IPO of Raspberry Pi, so a tech IPO. And tech IPOs have had a rough time in the last 5 years. Raspberry Pi seems to have been very successful. Can you tell us a little bit more about that?
Yeah, I mean, not a big transaction. They only raised circa 150 million, give or take, but really, really well received. A very good list of institutions that backed the company. I think it's testament to the fact that two things really: the price of the transaction was appropriate, and I think you're now seeing the institutional investors, the big pension funds and fund managers, are open for business in a way that they haven't been for several years. To my mind, that comes back to the same point that understanding where the cost of debt is and the cost of equity means they can make well-informed investment decisions. And I think one swallow does not make a summer, but Raspberry Pi is a very good indicator of where I think London can prove to be a source of the right capital at the right price and perform appropriately.
So for our members who could be thinking about IPO in the next 12 months, 24 months, it sounds like the backdrop is improving dramatically in terms of IPO readiness.
Well, we've got an amazing combination of political stability, very significant regulatory changes, which obviously with the listing rules done, but prospectus rule changes coming in the early part of next year. And as I say, I think we're coming through a sort of a turning point, having passed a sort of 30-year low in terms of transaction activity, and London is open for business in every way.
Now, one of the areas that there's been quite a lot of discussion on in the last 12, 24 months has been around retail investment, ideas around how to stimulate more retail investment. It ties a bit in with the Mansion House Compact and getting pension funds to get retail to invest through their pensions. There are still some rule changes that are needed to try and help on the retail side, I believe. Is that right? Yeah,
correct. So we are governed in the UK by prospectus rules that were set decades ago in Brussels. We're now not in the European Union, and we're free to set our own rules to our own game in that regard. It's ironic that the European regulator have adopted a lot of the changes we want to make and put them through faster than us, but we're going to get there very quickly, i.e. early next year. But the burden on businesses going public and then raising capital with appropriate documentation is getting a lot easier. The changes that really count in terms of IPOs are really around the fact that you historically have had to, if you want to run a public offer and put it out there to your customers, your employees and the broad public, you have to have the transaction open for at least 6 days. That is now recommended to drop to 3 days, because no longer do you have to print off the application form from the back of the prospectus and send it off in the post, which is when the rules were written. Obviously, everything can now be done electronically, and it's a wonderful thing that the individual investor can be given full information digitally and make an informed decision and be educated with ease, and then transact with ease again through digital means.
Okay, thank you. We've got a question from the audience, actually, from Simon Stokes at Connexus, asking: is the strength in the IPO market, is the growth in the IPO market, is it an indicator for future investment growth? So I guess he's trying to link that back perhaps to the discussion we were having with Steve. So if the IPO market is starting to improve, will that help? Will that stimulate more investment in the front end of the pipe?
I believe it. I believe it is, absolutely. I think it's very interesting. UK government. Sorry.
Sorry, you just cut out for a minute, James.
If you take the intended sale by the government of their stake in NatWest, which was obviously put on hold because of the election, that was an attempt by then Chancellor Jeremy Hunt to quote unquote bring back SID, so to wake up our public to understand the value around being equitized, owning shares in listed companies and investing for the future. That to me ties very nicely into the fact that we're seeing a really wonderful mix of businesses, founder-led, looking to go public, so that they're not ringing the bell and trying to sell out completely. It's a very important strategic step in the life cycle of said businesses. And I think if we get a signature of the right profile of those companies coming to market, it will absolutely wake up not just the public, but I believe deep pools of global capital that shows that London is open for business and has got none of the instability, political or otherwise, that we've been plagued with for so long. And I think that's really important because when one thinks about the Mansion House Compact and the need to wake up our pension fund industry to invest in both public and private instruments, it's true also to get international capital flowing back into the UK. And I think we'll see a reawakening of that in every way, as long as we're able to provide the right transaction flow in terms of available deals.
I'd like to throw the question back to Steve as well. So if the IPO market is starting to look good, do investors such as yourselves, does that encourage you that that there's an exit route, or are they too far apart for it to have an impact in your decision making?
I think it has to. Obviously, the IPO market opening up is just one corner of the market beginning to see some signs of life, but it has to start somewhere. And obviously, companies looking to IPO are much later stage, much more mature, much more established businesses than the kind of businesses that typically require VC investment. But I think for me, the key thing here is business like James, business like ours. We don't make money unless there's activity. I think one of the talking points we didn't quite get to was about the quote about VCs sitting on a lot of dry powder, and I think that statement really masks a reality of how venture funds operate. If you're not deploying capital into investments, you're not taking fee income. You're not drawing down your LP commits. Typical VC will deploy their investments and they'll raise a fund and they'll deploy 40, maybe 50% of that into initial investments in the investment period, and then the rest will be retained for follow-on investments. So that may be where the dry powder misnomer comes from. But the reality is, I think all market participants, we're not sitting on our hands because we don't want to be doing anything. We're sitting on our hands because there is a lot of conservatism in there, but everybody is waiting for signs of life to jump on. And I think the IPO market could be the first blinking light of sign of life. So let's hope so anyway.
Okay. Thanks, Steve. So I want to go on to the last section now, which is to talk to Adam Jackson from Innovate Finance about what the government can do to help investment. So the last 10 years, FinTech has been helped by a number of initiatives by the government and also through regulation. We're now really at the next stage of looking at the next 10 years and what can be done to help the next wave of investment. Because as we stand, we really are at an investment low point. It's not clear when it's going to come back and how, in what kind of volume it's going to come back. And we've heard that there are reasons why the volume might be lower. The Mansion House Compact may take longer to come through. It's great that the IPO market is now getting ready to take these businesses. But the question is, what else can be done in order to make UK FinTech more attractive for investment and to stimulate that investment? So, Adam, you've just published the FinTech Plan for Government, which post the election is setting out our ideas for what the government can be doing to help. Do you want to give us a précis and just pick out some of the ideas that you think could help to get investment moving?
Yeah, let's just start with what the election means for FinTech investment. And I think the key point is there's a lot of stability and continuity in policy. So a lot of the things we've talked about that government and regulators have been trying to do over recent years, actually the new Labour government supports as well. I think the difference may be with a very strong majority, with some fresh energy, and also with a strong focus on missions, they may actually drive those further and faster, and that will be what we're trying to help them do. It's a government that's very focused on what's called missions, and out of its 5 missions, their big one is growth. They also talk about opportunity for all, which I think plays nicely to fintechs as well, when we look at how fintech has kind of democratized financial services, increased access. But in terms of growth, clearly with over half of the unicorns in the UK, fintechs are driving growth, and in terms of how they then support productivity in the economy, not least with 60% of lending to SMEs, they're driving growth. So those are kind of key perspectives. The government is kind of gambling on raising growth without increasing spending and without cutting tax. So what that means is they can only do that by leveraging private investment and by either promoting growth through regulation, by enabling new innovation through regulatory changes, or by removing regulatory barriers. And I think that's the context for our plan for government, the kind of 5-year but also 100-day plan for strengthening the UK fintech ecosystem, responding to this dip in investment and looking at how we boost back up. And taking, I think, advantage of the opportunity that the UK now has political stability, which is starting to look pretty good when you look around the world. So the plan for government focuses on those 2 areas, really. How can regulation open up innovation and support investment, and how do we increase investment? One of the big areas we have focused on is a regulatory approach that enables smart data, so portable data, a data-driven economy.
Yep, you're okay,
Right,
Adam. You keep going. Yep, you're fine.
Yeah, apologies. So first one in our sort of 3 priorities for growing fintech for the new government, smart data economy, but that includes enabling AI. You can only data and AI go together, and digital assets. So promoting regulatory change that support that. Secondly, investment, and particularly policies that will support the Mansion House Compact, both by enabling more pensions to invest and providing vehicles. And we'll say a bit about that in terms of King's speech in a mo. And then thirdly, more broadly, regulatory models and regulators who support growth, backing the new competitiveness and growth objective of the regulators. And also, actually, I think it's worth mentioning financial education and financial inclusion, because unless we equip everyone with the tools to better manage their finances, then they may be less confident in investing in fintech. And I think just the final thing I'd mention in all of this, when we look at some of the figures you showed early on of the top 10 countries for fintech investment, so some of the countries that are potentially catching up with us, India, Brazil, Australia, Hong Kong, Singapore, they have all introduced innovation, particularly around smart data, digital ID. They have all got regulators and central banks who have looked at different regulatory models and really kind of taken and built on the sandbox that the UK initially pioneered in. So this is about leapfrogging them in terms of approaches to investment and regulation.
And was there anything in the King's speech today, Adam, which tells us this is going to get moving?
Yeah, absolutely. And it touches on both of those 2 areas of regulation that can enable innovation and unlock new innovators, and supporting the Mansion House Compact. So the big one, and something that we prioritised and called for, was a smart data bill, which will enable the UK to put open banking, which has done so much to grow a lot of our fintechs and brought investment in. build that out and develop that into other sectors and open finance, as well as enabling digital verification or ID services. Well, there's a lot of new startups and indeed more established fintechs developing services. We know there's kind of money waiting to invest, but they need the regulatory framework for that as well. So great news there. We asked for that, and they've delivered. We now have to get the bill through, but that's the legal underpinning for basically a smart data economy. And the second one is, I think, supporting the Mansion House Compact, both a bill on a national wealth fund, which in part will invest 7.3 billion through both the UK's infrastructure bank, but also the British Business Bank, and therefore potentially creates an extra vehicle for institutional investors to invest in tech. We need to see which sectors are in scope and make sure fintech can benefit. But that's, I think, good news for one extra vehicle. And then also pensions bill, which, although focused on the, if you like, the consumer end of things, will in particular drive consolidation of DC funds, which will enable more of those funds, I think, to invest in UK equities by creating bigger funds that can therefore diversify and can therefore take some of the risk. So there's measures there that are sort of some of the structural reforms that support the Mansion House the Mansion House Compact.
Great, thank you, Adam. And just got a couple of minutes out. Simi, I just want to bring you in again. I mean, you sit at the heart of all the different parts of the financial services market in the city and its relationship with government. How are you feeling about the government and its potential impact on fintech and financial services?
It's a tough question, Mike. I'm just going to call you out there. It's week 2, but and I've been out of the country for one of those weeks, so I don't want to repeat, some of the generalities, but I'll try and do it justice. It's early doors, as I just said, and I think we as a country have given them a mandate to apply fresh thinking. That doesn't happen overnight, and so especially we want them to do that with stability that they have also promised, and this will take time. So I suppose what I'm saying is my views are still forming. A couple things to share with listeners. I do feel as though the entire country is better aligned on the growth agenda than maybe it has been in 30 years. And so that makes me very optimistic. And we look forward as the City of London Corporation and playing our part in that across the UK. This is definitely the time for any and all solution-based ambitions that we want to throw into the hopper. And my conversations at various levels with the new government reflects the fact that no idea is unwelcome. I think what's really good news is that, we worked very well with the last chancellor, and our relationship with the new chancellor is just as good. And the interest in the Mansion House Compact and its aims have totally survived the election. It's the first thing we're asked about, and usually the second. And we think that we can take that work quite seamlessly into the things that Adam has mentioned, the pension scheme bill, probably first. That's probably our first priority, and then moving on to the concept of a national wealth fund. It also has been said they have 5 missions, but they are just generally mission-driven as a government. All arguments and asks and ambitions need to be placed in that lens. And I think this sector has a lot to offer, right, in terms of job and wealth creation. The last point I'm going to make, I think we all collectively need to tell the story abroad about this government and what they're up to, and the fact that they will bring us, we're optimistic that they will bring us innovation with stability. I don't know, I've just coined that, but I think there's perhaps some misconceptions abroad based on my travels about what I feel is generally an optimistic picture.
Okay, great, Simi. That's really useful. Thank you very much for giving that perspective, particularly the wider international perspective. That was really helpful. So we're going to wrap up now. One last question to everyone. So a couple of weeks ago, I polled the Innovate Finance board and said, what will investment do in the second half of this year? They said flat with a sort of possible downside. A lot of our people watching this, that's what they're interested in. Where's investment going to go the next 6 months? Steve, you've already said to us, I think you said something similar, you're not expecting it to recover until the end of the year. I think that's what you said, is that right?
Flat to a little bit up.
Okay, flat to a little bit up, and you're a born optimist. Simi, how are you feeling about investment in the next 6 to 12 months?
I'm going to say up for two reasons. One, I'm also a natural optimist, but also I know about an announcement I couldn't say today that's coming. So I'm going to say up.
Oh,
gosh. James, listed markets and unlisted markets.
Well, look, I mean, I'm afraid I carry a similar trait to others as a sort of founder's optimism sort of ingrained in me. But much more importantly, and I think this is interesting, just reflecting on the last point Simi was just talking to, it's really interesting. You've got people like Peter Harrison as the soon-to-be exiting but chief executive of Schroders, who has stood on a stage on many occasions and said, look, we're guilty here as one of the biggest pension fund operators in the UK because 10 years ago, over half the assets they managed were in UK equities. Today, it's less than 2%, right? That's an extraordinary fact. And so it's really interesting. We don't have the home bias that just about any other nation has in terms of investing in our own businesses, public or private. And whilst we've been pulling on all levers to see regulatory change and government support for these matters, the most interesting thing is that industry itself recognizes the problem. And so whether it's, looking at the Mansion House Compact, whether it's listening to Nick Lyons as chairman of Phoenix and ex-Lord Mayor, or equivalent from Aviva and Legal and General and so on, the stage is now set for companies, public and private, to raise capital from a much, much broader pool of both domestic and I believe international sources. So there's only one way we're going, and I think it's up, and I think it could start to happen quite quickly.
Thank you, James. Adam?
I'm going to say up. I think there's just greater alignment between regulators, government and industry for the reasons people have said, and just the increased optimism perhaps around IPOs and listings. So I'm going to go for an uptick.
Great, thanks. Veronica?
Well, I'm going to put numbers behind it, Mike. So if we look at 2023 investments where the UK pulled in $5 billion into its fintech sector, we're just under halfway there to make it. And we've already kicked off July with, Nala Money raising a $40 million Series A, which is massive for Europe, but also even more further afield. And I don't know, Simi's now got me really, really tempted to hear about how big are some of these announcements going to be. But look,
I think we all need a side chat with Simi, don't we?
Yeah, I think if
we're rushing to our bookmaker.
I think if half two is as good as half one was, then we'll be just slightly under, but who knows?
Great. All right. Look, that's where we're going to wrap up. We've overrun a bit, but there were good reasons. A lot of interesting points came out, and it's a very it's just the markets have been in a state of flux for 18 or so months, and it probably will continue to be for a while. So we're all looking for signs and patterns as to when it might turn up. So it's really helpful to get the views of all of the experts that we've had on the call today. You can find our report on the website. Adam, your report is also on the Innovate Finance website. So I'd like to thank the panelists, Steve, Simi, James, Adam. Thank you very much for being here today.
Thank you.
Thanks for having us.
Everyone.
Goodbye.
Thank you.